All right, so now we are discussing calculating an impairment loss. And I told you that when we are conducting an impairment review simply involves comparing the carrying amount with the recoverable amount. So we are going to compare the carrying amount of an asset, which is the book value, against the recoverable amount, which is the realistic amount. So whenever we are assessing the impairment of an asset, we need the carrying amount at the date on which we are assessing the impairment. So carrying amount at the date of the impairment review being conducted. And then we need the recoverable amount, which is higher of what? Value in use and fair value less cost to sell. And we know the value in use is the present value of future cash flows. Present value of future cash flows. And I told you the method, how you're going to calculate it. So first of all, you will be taking the years, for example, year 1, year 2, year 3, and then take the cash flows and then multiply it by the discount factor, and then you will get the present value. This net present value, the total, is actually the present value of future cash flows. And then we have to compare it with the fair value less cost to sell, which is eventually the NRV. Whichever is higher becomes your recoverable amount. So if the carrying value of an asset is more than its recoverable amount, then asset is said to have suffered an impairment loss. An impairment should be recorded within the financial statements. So an impairment occurs if the carrying amount of an asset is greater than its recoverable amount. We know that. The recoverable amount is higher of fair value less cost to sell value use. Okay, fine. The fair value is measured from the active market. We already know what is active market. Active market is where the asset is being traded, where the buyers and sellers are available, where the similar and identical assets are available, where the prices are available. And cost to sell is simply the cost to sell. That means the cost necessary to sell the asset. And then we have the value in use. Value in use is the present value of the cash flows, both the inflows and outflows related to that asset. So remember one thing, whenever we are taking the estimated cash flows, first of all, this should be a best estimate. It should be a best estimate. And the second thing is that the years should not be more than 5. Like we are going to take maximum 5 years in the calculation of the value in use, maximum 5 years. Because more than 5 years means the cash flows becomes unrealistic, and there are too many chances of those cash flows being unreasonable. So that is why we are going to take the maximum 5-year cash flows unless a longer period can be justified. Now, for example, if there is an asset, you are having an asset, and let's assume a company is having a car, and they have contracted with someone, they have rented their car to a company or to an individual for 7 years. And the rent will be coming for those 7 years. Now, in that case, you already know that this will be giving you benefit for the 7 year, and this 7 years you are reasonably sure about. In that case, if the longer period can be justified, then it's fine. Otherwise, you will not be taking more than 5-year cash flows. And here are a few things that you need to remember regarding the estimations of the cash flows. Again, there's no need to learn that, just you have to understand it. Okay, the first point. The cash flow projection should be based on the reasonable assumption. When we say the reasonable assumption, it should be the best estimate. And when we say the best estimate, there should be some basis for those best estimates. Like for example, I'm having an asset and I've already used it in the previous 2 years. I've already used in the year 1 and the year 2. Now I am assessing the impairment, and for that, I need the future cash flows. Okay, so we have year 3, year 4, year 5. Let's assume we are going to take the cash flows of 3, 4, 5 years. Now, when we are considering how much we will be earning by using this asset in the year 3, 4, and 5, we should see how much we have earned in the recent past. Because, for example, if you have earned, let's assume 50 in the year 1, and for example, 52 in the year 2, You cannot take directly 80 over here. Now, this is going to be unreasonable. Like you have to justify why you are having an immediate jump from 52 to 80. So whatever it is, it should be a best estimate, and it should be based on the most recent budgets and forecasts, most recent figures you are having. The second point is the cash flow projection should relate to the current condition. Like when we are talking about the future cash flows, we will be considering the current position of an asset in which it is able to make the produce the cash flows. Like don't assume that okay, you will be having something on it, you will be installing something on it, and then it is going to be capable of making this much cash flow. No, when you are taking the cash flows, you have to take the current position of an asset, current condition of an asset, that in the current condition how much this asset will be able to produce. Then in excess of the 5-year cash flow, like usually we take the cash flows of maximum 5 years, but for example, if the longer period is justified, you are having more than 5-year cash flows, then you have to see that after those 5 years, there will be some movement in the cash flows. Either it is going to be steady or declining or zero growth rate. And again, management should assess the accuracy of their budgets by investigating reason for any differences between forecast and actual cash flows. Let's assume we are having an estimate that okay, we'll be generating 50 in the year 1, and then you see this was the estimate. Now the actual cash flow, what you have earned from year 1 is, let's assume 20. Now there's a significant difference between the 50 and 20. Now you have to revise your accounting estimate if the actual results are significantly different from ones you have forecasted or ones you have projected. So these are the points that you need to remember regarding the cash flow, that it should be a best estimate. And again, when you're assuming the cash flows, it should be based on the current condition of the asset. And simply, whenever your estimate is going bad, you have to revise it. So now we are discussing the recognizing impairment losses in the financial statement. Now this is the same thing what we have studied in IAS 16. Okay, whenever there is an impairment loss, whenever there is an impairment loss, you have to see two things. The first thing is whether this asset was previously revalued and gain recognized in revaluation surplus, which is still there. So when you're having an impairment related to any asset, impairment loss related to any asset, you have to see whether this asset was previously revalued and there was a gain recognized in the revaluation surplus, which is still there. If that is the case, then first of all, you have to reverse the revaluation surplus related to that asset. Still, if there is any impairment, that will be recorded to the profit or loss and credit goes to the asset. So whenever you're charging an impairment loss, you have to see this first, whether this asset was previously revalued and whether there is a revaluation surplus related to that. Okay, so if there is no revaluation or no surplus, then directly the impairment loss will be recorded in the profit or loss. So debit profit or loss and credit asset. And once you have brought the asset to its recoverable amount, because we know that we have to record the asset at lower of its carrying amount and recoverable amount, whichever is lower, it should be recorded on the lower value. So let's assume the recoverable amount is lower. So when we have brought the asset on its recoverable amount, just like the revaluation, now the depreciation will be recorded on the recoverable amount and remaining useful life, just like we used to do in revaluation. When we were doing revaluation, we were charging depreciation on revalued amount and remaining useful life. Here, the same principle applies. Whenever you have brought the asset to its recoverable amount, now the depreciation will be charged on the recoverable amount and the remaining useful life. This is something very important to understand. Okay, now we have an example. On 31st December 20x1, An entity noticed that one of its items of the plant and machinery is often left idle. On this date, the asset had a carrying amount of 500,000 and the fair value of 3,25,000. The estimated cost required to dispose of the asset are 25,000. If the asset is not sold, the entity estimates that it will generate cash inflows of 200,000 in each of the next 2 years. The discount rate that reflects the risk specific to this asset is 10%. Now we know whenever we are assessing an impairment, we have to compare two values, which is the carrying value versus the recoverable amount. Now carrying value is the book value, which is being given straight away 500,000. Now recoverable amount, is higher of what? Value in use. Now value in use we have to calculate because here we have how many years? We have 2 years, year 1, year 2. In the year 1, there will be an inflow of 200,000. In the year 2, there will be an inflow of 200,000. And we know the 10% thing, 1 plus 0.1 raised to power minus 1. That means 1 plus r raised to power minus 2. And this is going to give you the value in use. Okay, we can see the answer directly. So this is 3,47,000. Let me just take this figure from here. So the value in use is 3,47,000, right? And now what is the fair value less cost to sell? They have already told us that the fair value is 3,25,000, fine. And they suggest that the cost to sell is 25,000. So deducted, you will get the fair value less cost to sell of 300,000. And we know that recoverable amount is higher of value in use. Which one is higher? Value in use is higher. So we take this value as the recoverable amount. Now we have to compare carrying value versus the recoverable amount. We know the carrying value is 500. We know the recoverable amount is 347. So difference between these two is 153, which should be recorded as an impairment loss. The journal entry should be debit profit or loss and credit asset by this amount. So then they have, how would the answer to the part A, which we have calculated, 153 is the impairment loss, sorry, be different if there was a balance of 10,000 in the other components of equity relating to the priority valuation of this specific asset. They said like you got the impairment loss of 153 and you already have a revaluation surplus related to this asset of 10,000. Now how to record this? First of all, you have to de-recognize the revaluation surplus, so how much this will be by 10. Then the remaining impairment loss should be charged to the profit and loss, which is 143, and credit goes to the asset, the total figure, which is 153. So this is how we are going to record the impairment loss. All right, now we have another example. A company that extracts natural gas and oil has a drilling platform in the Caspian Sea. It is required by the legislation of the country concerned to remove and dismantle the platform at the end of its useful life. Accordingly, the company has included an amount in its accounts for removal and dismantling cost and is depreciating this amount over the platform expected life. We know this from IAS 16 that if you have a legal or constructive obligation in relation to the dismantling, then you have to record that cost in the asset and the corresponding entry is recorded as a provision. The company is carrying out an exercise to establish whether there has been an impairment of the platform. Okay, now whenever we are conducting an impairment review, again, we need two figures. We need to compare the carrying value with the recoverable amount. Its carrying amount in the statement of financial position is 3 million. Okay, we got the figure of the carrying value, fine. Now we need the recoverable amount, which is higher of value in use and fair value less cost to sell. Okay, fine. So the company has received an offer of 2.8 million for the platform from another oil company. The bidder would take the responsibility for dismantling and removing the platform at the end of its useful life. So someone is ready to buy from us this drilling platform for 2.8 million. That means this is the fair value of the platform, because if someone is ready to buy this from us in 2.8 million, this represents the fair value. The present value of the estimated cash flows from the platform's continued use is 3.3 million. Like if we are not selling it, instead we are using it, we will be having 3.3 million from the cash flow, which is the present value. But as we discussed earlier, that you have to take both the cash inflows and outflows related to that asset. When you're using it, it will be your responsibility to dismantle it. And when you will be dismantling it, there will be a cost of it. So you have to deduct that cost from the cash flows, cash inflows. Carrying amount in the statement of financial position for the provision of dismantling and removal is currently 0.6 million. So you deduct 0.6 from it, and the resulting figure 2.7. Resulting figure 2.7 is going to be the value in use. Now, yes, 2.7 exactly. Okay, now which one is higher? 2.8 is higher. Yes, 2.8 is higher. That becomes the recoverable amount. Now we have to compare the carrying value with the recoverable amount. Carrying value is 3 million. Recoverable amount is 2.8 million. Which one is higher? Carrying value is more than the recoverable amount. Then the asset has suffered an impairment loss of 0.2 million. So you see, when we are selling this asset, we are selling it at 2.8 million. And when we are selling it, it will be the buyer's responsibility to dismantle it. So that means we will not be having any obligation in relation to the dismantling. When we are using it, the benefit that will be coming from the use is 3.3 million. But when we are using it, we have to dismantle it ourselves. The cost of that dismantling is 0.6 billion. You have to deduct it. And the net cash flows, this is going to be the net cash flow you will be getting from the use of that asset is 2.7. The higher is 2.8 billion, which becomes the recoverable amount. Still, the carrying value is more than the recoverable amount. As a result, an impairment loss of 0.2 million will be recorded. All right, now we are discussing the concept of the cash generating unit, and I have already given you the flavor of this cash generating unit. Like when we are assessing impairment of the asset, it can be an asset. It can be an asset, that means the individual asset, or it can be the group of assets. So whenever you are having the impairment thing, now impairment can be related to an asset, that means the individual asset, or it can be related to the group of assets. And I give you the example of the factory. For example, factory. Like when you talk about the factory, within the factory, there are multiple assets. Like for example, there is production line, there's assembly line, there are machineries, there are tools, there are equipments, and all of those things are integrated with each other, synced with each other, and they produce a combined cash flow. For example, you talk about probably you have seen those videos on the Nat Geo and things like that. For example, a company making the peanut butter. Probably you have seen that. Now, first of all, they need to collect the peanuts. Like obviously they have the peanuts. Then obviously they will be washing it to clean it. Okay, then there's a washing. They have a machine which is washing, not the washing machine. In fact, they have a machine which is washing the peanuts. And then there's a machine that will be drying the peanuts. And then there will be another process, and then there will be another process. The last process is going to be the packing. Now, all of these machines are ultimately integrated to make the peanut butter. So for example, if the demand of that peanut butter is decreasing in the market, that means this is an indicator of the impairment. all those assets within the factory are subject to the impairment. So instead of assessing the impairment of individual asset, we are going to assess the impairment of the whole cash generating unit, which is the group of assets, for example, the factory. So sometimes we are having the group of assets, like for example, the factory. In that case, we will not be assessing the impairment of individual assets. Instead, we'll be talking about the group of assets. So sometimes it is not usually possible to identify cash flows relating to the particular asset. For example, a factory production line is made up of many individual machines, but the revenues are earned by the production line as a whole. This means that the value in use must be calculated for group of assets rather than individual assets. So what you will be doing is you will be comparing the carrying value of CGU with the recoverable amount of CGU. Now, there is a process, there is a complete guidance how to record the impairment to the cash generating unit. What is that we'll be dealing in this slide. So the first thing is that you have to calculate the carrying value of the complete CGU. Now the good news is this will be given in the exam. Now you have to compare it with the recoverable amount of the CGU. Again, this will be given to you. So if the carrying value of the CGU is more than the recoverable amount, then the asset has said to suffered an impairment loss. Said to be suffered an impairment loss. Now, how this impairment loss should be recorded? First of all, it should be allocated to the specific asset. Now, specific asset means, for example, within the factory, you can see that that particular asset is redundant, that particular asset is damaged, that particular asset has no value. First of all, you are going to charge impairment to those specific assets, which can be seen, in fact, directly that they have impaired. They are impaired, in fact. And then the impairment will be charged to the goodwill, and then other assets on pro rata basis. Now, pro rata means the percentage basis. We'll be doing many examples in a while. So what you have to do is calculate the impairment loss by comparing the carrying value of the CGU with the recoverable amount of the CGU, sorry. If there is any impairment, first of all, charge for the specific asset, then goodwill, and then other assets on pro rata basis. And remember one thing, take a note that assets which are already on their recoverable amounts should not be charged or should not be allocated any impairment. You are not going to allocate the impairment to the assets which are already on their recoverable amount. For example, you talk about the inventory. IAS 36 does not apply to that because it has its own principle, lower of cost NRV. Receivables, it's a financial asset. IAS 36 does not apply to it because those receivables are already recorded on the recoverable amounts by creating the allowance and things like that. And then we have the cash. Cash does not impair. So eventually the current assets, we do not charge the impairment to the current assets. And there's one more. This was the first thing. And the second thing, asset whose recoverable amount is more than carrying value. So you are going to charge impairment to all assets except for the assets which are already on the recoverable amount, such as the current assets, and the asset whose recoverable amount is more than the carrying value, because we know when the carrying value is more than the recoverable amount, then there is an impairment. If the recoverable value is more, then there is no impairment. So first of all, the specific asset, then to goodwill, and then other assets on the pro rata basis. Okay, now we have an example. TiNet has identified an impairment loss of 41 million for one of its cash generating units. The carrying amount of the unit's net asset was 150 million, whereas the unit's recoverable amount was 109 million. So we know that we have to compare the carrying value of the whole CGU with the recoverable amount of the whole CGU. The carrying value is 150 and the recoverable amount is 109. As a result, there is an impairment loss of 41 million. So the net selling price of the unit assets were insignificant except for the property, which had a market value of 35 million. So you see, the property's carrying value is 20 million and the recoverable amount is 35 million. So that means the recoverable amount here is more than the carrying value. So that means there's no impairment of the property and no impairment should be allocated to the property because here the recoverable amount is more than the carrying value. Then they said the net monetary asset we know usually the current assets, will be realized in full. These are liquid assets, will be realized in full. That means this is already equal to their recoverable amount. So no impairment should be charged to the net monetary assets as well. Now, there's no specific asset in the question, which they told nothing about this. So first of all, we'll be charging the impairment to the goodwill. Goodwill is 31. Now the whole thing will be written off. Okay, let me use my calculator. So how much it is? 41 minus 13 is equal to 28. Now we have to charge the impairment to other assets on the pro rata basis. Now what is pro rata basis? And what are those other assets? Machinery, vehicles, and patents. These are the three remaining assets which we have to charge impairment. So total at first, 49 plus 35 plus 14. It gives you 98. Now the 98 will become the denominator. So first of all, you'll be charging the impairment of the machinery. How come? Machinery value is 49, divide by 98 into the remaining impairment, which is 28. Then the vehicles, the value of vehicle is 35. How much it represents of the total three assets? This is known as the pro rata basis. That you are calculating the percentage of machinery with respect to these three total assets. You are calculating the percentage of vehicle with respect to the total of these three assets and then multiply by the $28. Similarly, we have the patents. So 14 divided by 98 into $28. So this way, now let me calculate for machine. Okay, machinery is 49 divided by 98 multiplied by 28. It gives you 14. So 14 is the impairment which has been allocated to the machine. Now, what value the machine will be recorded? 49 minus 14. So 35 is going to be the revised value of the machinery. Similarly, you're going to do with the vehicles. 35 divided by 98 into 28. It is going to give you 10. So at what value the vehicles will be recorded? 35 minus 10 is equal to 25. And then similarly, you have the patent, which is 14 divided by 98 into 28. It is going to give you 4, obviously, because the total impairment is 28. So now the patent will be 14 minus 4. It will be recorded at $10. So if you total these assets, 35 plus 25 plus 10, it is going to give you 70. So this is how we are going to record the impairment. Okay, so we have another example. There was an explosion in a factory and the carrying amounts of its asset were as follows. Okay, the total carrying amount is 2,600. And we know we have to compare it with the recoverable amount. Okay, so the carrying value is $2600, and the common 000. And then we have to compare it with the recoverable amount, which is higher of value in use and fair value less cost to sell. Sorry. So they said the factory operates as a cash generating unit, and impairment review reveals a net selling price of 1.2 million. Net selling price means it's already fair value less cost to sell, 1200. And value in use of 1.95, that means 1950. So which is higher? Value in use is higher, which becomes the recoverable amount. So carrying value is more than the recoverable amount. Carrying value is $2600, which is more than 1950, and it gives you impairment of 650. 650 is the impairment loss. Okay, now we remember the sequence. That first of all, we have to charge it to the specific asset, then we have to charge it to the goodwill, and then we have to charge it to the other assets on pro rata basis. Half of the machines have been blown to pieces. Blown to pieces simply means completely damaged. Okay, half of the machines, so that means 300, half completely damaged. So that means the impairment loss is 650. Okay, right? Impairment loss is 650. First of all, we have to charge the impairment to specific asset, which is machinery, 150, blown to pieces, nothing left. But the other half can be sold for at least their carrying amount. The other half is 150. It can be sold for at least their carrying amount. That means here, the carrying value is equal to the recoverable amount. So this 150 should not be allocated any impairment. The patents, okay, the amount of which is 200, have been superseded and are now considered worthless. So again, there is no worth left of the patents. Okay, that means you have to write off the patents. Again, specific asset which has been impaired. So once you are done with this 350, the remaining impairment will be 300. Now we have to charge it to the goodwill first. So goodwill is 100. Now the remaining is $200. Now this $200 should be charged to the other assets on pro rata basis. What are the other assets? Computers in the building. So you take the total of it, which is 2,000. So 500 divided by 2,000 into the impairment, which is 200. Similarly, 1,500 divided by 2,000 into the remaining impairment, 200. So this is how you are going to charge the impairment to the computers and the buildings. All right, so we are discussing the reversal of an impairment loss, and this is the most important thing within IAS 36. But before getting into the reversal of an impairment loss, we need to understand the idea first. And the idea is that when we did the revaluation, the upward revaluation, the double entry was like debit asset, and debit is accumulated depreciation if it's a depreciating asset, and credit revaluation surplus. This was the double entry when we did the revaluation. And then we had an impairment loss. When we had an impairment loss, we said that first of all, you have to reverse the revaluation surplus of this asset. If still there is any impairment loss left, then you're going to charge it to the profit and loss, and credit goes to the asset. So if there is an impairment loss related to an asset which was previously revalued, then first of all, you have to reverse the revaluation surplus. If still there is any impairment loss left, then you're going to charge it to the profit or loss, and credit goes to the asset. Now, carrying the same idea again, that impairment is dependent on the indicators. Impairment is dependent on the indicators, whether internal or external. You already know that from the previous slide. Now, the idea is, what if those circumstances, those events which caused the impairment has now reversed? it is possible that based on the indicators on which you have charged the impairment, those factors, those events, those circumstances has now been reversed. If those factors have now been reversed, then you need to reverse the impairment loss as well. So the calculation of impairment losses is based on the prediction, that means in the indicators of what may happen in the future, because it's an accounting estimate. Sometime actual events turn out to be better than predicted. Now the factors based on which you have charged the impairment may reverse. If this happens, the recoverable amount is recalculated and previous write down is reversed. That means you have to reverse the previous impairment which you have charged either to the profit or loss or to the revaluation surplus. Both, we'll be talking about the both. If it was the impairment that has been recorded from the revaluation surplus, then the credit will go to the revaluation surplus. If that impairment was recorded through the profit or loss, that means the debit entry was in the profit or loss rather than the revaluation surplus, then the reversal will be the credit to the profit or loss. So impaired assets should be reviewed at each reporting date to see whether there are indications that the impairment has reversed, like the asset on which you have charged the impairment, you have to see it every year annually to see whether those factors are now being reversed. If that is the case, then you have to reverse the impairment as well. A reversal of impairment loss is recognized immediately as income in the profit or loss. Now, if it was to the profit or loss, then the credit will go to the profit or loss. If the original impairment was charged against the revaluation surplus, then again the credit will go to the revaluation surplus. So carrying the same thing. If it is from the revaluation surplus, then credit goes to the revaluation surplus. If it is from the profit or loss, then credit goes to the profit or loss. So this is the idea behind that. Now, the main thing which you need to understand is the value of the reversal, the amount of the reversal. The standard has a specific guideline regarding that. First of all, I'm going to read these lines, and you will be able to understand these lines with the help of an example. Without an example, I don't think so you will be getting the idea. Okay, let's read these lines first, and then we'll be doing an example. The reversal must not take the value of the asset above the amount it would have been if original impairment had never been recorded. The depreciation that would have been charged in the meantime must be taken into account. Now, whenever you have a reversal of an impairment loss thing, remember, you have to calculate the carrying value now, and the carrying value had the asset not been charged any impairment. And you cannot take the asset beyond that. Now, again, I told you have to do an example. Okay, we have an example over here. Boxer purchased a non-current asset on 1st January 20x1 at a cost of 30,000. Now I need your attention in this example because this is a very important concept. So the Boxer purchased an asset, the cost of which was 30,000 on 1st January 20x1. At that date, the asset had an estimated useful life of 10 years. We know that how to calculate the per year depreciation. The per year depreciation is cost divided by the useful life, how much it is, 10 years. So the depreciation per year is $3,000, right? Boxer does not revalue this type of asset, but accounts for it on the basis of the depreciated historical cost. That means this asset is on the cost model rather than the revaluation model. At 31st December 20x2, now how many years? 2 years after, the asset was subject to an impairment review and had a recoverable amount of 16,000. We know that whenever we are conducting an impairment review, what we are doing, we are comparing two things. We are comparing the carrying value with the recoverable value or the recoverable amount. Now, at what date we are carrying out the impairment review? On 31st December 20x2. That means 2 years have been passed since we bought it. So the depreciation that will be deducted and you will get the carrying value. Okay, 30,000 is the cost. Now you need to deduct the 2-year depreciation. So $3,000 per year into 2. It gives you 6,000. So 30,000 minus 6,000, the carrying value should be 24,000. Now, this should be compared with the recoverable amount, and that is being given. So carrying value is more than the recoverable amount. That means the asset has suffered an impairment loss. Now, what is this? This is 8,000. 8,000 is the impairment loss that has been suffered by the asset. 8,000. Now, we have no idea whether this asset was previously revalued. So that means all of the impairment should be recorded directly to the profit or loss. So profit or loss debit by 8,000 and credit asset by 8,000. Fine. And now we know that once the asset has been brought down to the recoverable amount, now the new depreciation should be charged on the recoverable amount and the remaining useful life. Now the recoverable amount is 16,000 and the remaining useful life at 8 years. So now we will be depreciating it. The new depreciation per year will be 16,000, which is the recoverable amount, divide by 8 years, which are the remaining years, and you will get the per year depreciation of $2,000, right? Now, at 31st December 20x5, now again, after further 3 years, the circumstances which caused the original impairment to be recognized have reversed. I told you that impairment is based on the indicators. Now, the thing which was based on which are the impairment has now been reversed, and now we need to reverse the impairment loss as well, and are no longer applicable, with the result that the recoverable amount is now 40,000. Now, first of all, we need the carrying value at this date. Okay, how are we going to do that? How are we going to do that? So carrying value at 31st December 20x5, and we have already discussed it, that once we have revalued the asset or we have charged an impairment loss, the new depreciation is being charged on the revalued amount or the recoverable amount. So the recoverable amount is 16,000 over here, and now you need to deduct 3-year depreciation, which was 2,000 into 3, and you get 10,000, which is the carrying value at 31st December 20x5. So let me just recall it what we have done. The asset was bought for 30,000, life is 10 years. We got a depreciation per year of 3,000. Okay, after 2 years, the impairment review has been conducted. So we need to compare the carrying value with the recoverable amount. Carrying value after 2 years was 24,000 and the recoverable value is 16,000. So because the carrying value is more than the recoverable amount, the asset has been suffered an impairment loss, which is 8,000, and this should be directly recorded to the profit or loss, as we have no idea, no information regarding the previous revaluation. Now, once the asset has been brought down to the recoverable amount, the new depreciation should be charged on the recoverable amount and the remaining useful life. So the remaining useful life after 2 years is 8 years. Now the new depreciation charge is 2,000 per annum. Again, at 31st December 20x5, after further 3 years, they're conducting again the impairment review. And the factors based on which impairment was charged has now been reversed. And now what we need to do, we need to reverse the impairment loss as well. So the carrying value is 10,000 at that date. The student will make a mistake. Then what they're going to do is they take this carrying value again to the recoverable amount of 40,000, which is incorrect. You cannot do that because it's not the revaluation model, right? It's not the revaluation model that straight away you can take. Even in the revaluation model, yes, you cannot take that directly because there is the thing which we are going to discuss now. Okay, what we are going to do. So we need the carrying value had the asset not been impaired. We need the carrying value assuming if there was no impairment. So the cost was 30,000. The cost was 30,000 and per year depreciation was 3,000. What if there was no impairment? That means asset till now would have depreciated for 5 years. So that means 3,000 into 5, 15 minus 30,000 is equal to 15,000. So the standard says that you can reverse the impairment of only 5,000. You can take the asset to the value maximum where it would have been if there is no impairment, if there was no impairment. You cannot take the asset now to the recoverable amount, which is the new value. You can only take the asset to the amount if there was no impairment. That means the 5,000. Now the problem with this idea is that we originally charged the impairment of 8,000 to the profit and loss. Why we are only reversing 5,000? Like there should be the reversal of 8,000. We are only reversing debit 5,000 asset, credit profit or loss by 5,000. Why is that? Now this is the answer you will be getting now. What was the impairment loss in total which you recorded earlier? It was 8,000, right? 8,000 was recorded in the profit and loss. Now the depreciation of this asset would have been originally 3,000 per annum. But due to this impairment, you were charging depreciation of 2,000 per annum. Every year you were charging 1,000 less depreciation. So for 3 years, you charge less depreciation of 3,000. 3,000 less depreciation. Now, if you see the net thing is 5,000, that means you have reversed the impairment of 3,000 in the form of reduced depreciation every year. So that is why the standard is saying that you cannot take the asset beyond to the value it would have been if there was no impairment. And now again, we are going to read these lines. The reversal must not take the value of the asset above the amount it would have been if the original impairment had never been recorded. That means you cannot take the asset beyond to the value if there was no impairment. And the next lines are very important. The depreciation that would have been charged in the meantime must be taken into account, that every year due to this impairment, you are charging less depreciation of 1,000. Now this less depreciation of 1,000 every year was recorded in fact as an income. So that is why we are not reversing 8,000 directly. We are doing it 5,000 because 3,000 has already been reversed in the form of the reduced depreciation. So this is one of the most important concept within the IAS 36, which is reversal of an impairment loss. All right, now we have another example of the reversal of the impairment loss. On 31st December 20x2, an impairment review was conducted on a cash generating unit, and the result were as follows. Okay, we have the asset, which is the goodwill and the property, plant and equipment. We know once there is an impairment of the cash generating unit, first of all, you have to charge it to the specific asset, then the goodwill, then other assets on the pro rata basis. So you see, the goodwill has been fully written off. And we know that once the goodwill has been written off, you cannot reverse the goodwill because otherwise it is going to be the internally generated goodwill. Once the goodwill has been written off, you cannot reverse the impairment related to the goodwill because it is going to be internally generated thing then. So the goodwill, it was fully written off, no value now. And then we have the property, plant and equipment. The carrying value was 300. The impairment recorded is 120. And now the carrying amount is 180. At what date? 31st December 20x2, right? The property, plant and equipment was originally purchased for 400,000 on 1st January 20x1 and was attributed a useful economic life of 8 years. Now we know the cost. The cost is 400,000. 400,000. It is going to be divided by 8 years, and the depreciation per annum is going to be, depreciation per year is going to be 50,000. So they conducted an impairment review after 2 years of the asset purchase. Now that means that the asset would have been 300. Now how this 300 has been calculated? 400 is the original cost minus 2-year depreciation, so 50 per year into 2. So that is why you got this carrying value of 300. And we know once the asset is brought down to the recoverable amount, the new depreciation is charged on the recoverable amount and the remaining useful life. So now the asset has been brought down to 180, which is the recoverable amount. Now the new depreciation, this is the recoverable amount, new depreciation should be charged on the remaining useful life. Okay, so after 2 years, how many years are left? Total were 8 years, 6 years are left. So 6 3 the 80, now the depreciation would be 30,000 per annum. At 31st December 20x3, the circumstances which caused the original impairment have been reversed and no longer applicable. The recoverable amount of the cash generating unit is now 420,000. We are not concerned with this amount. We are concerned with the carrying value now. Carrying value now means 31st December 20x3. And how this should be calculated? 180 minus 30. 1 year depreciation because it is being reviewed after a year. So that means carrying value now is 150. And now we need carrying value if no impairment was recorded. What it should be? It should have been 400, which is the original cost, minus how many years of depreciation? 3 years of depreciation, which is 50 into 3, 150. The carrying value would be 250 had there been no impairment. Now that means you can only record the reversal of 100. So what you're going to do is debit asset by 100 and credit profit or loss by 100. This is how you're going to record the reversal of an impairment loss. So the gain of 100,000 should have been reversed.